and welcome to your latest Carson's Take 5. Ryan and Sonu here. Sonu, we had good news last week on the video. This week we're going to talk about why the lows could be in. We've got a heck of a rally the last 4 to 5 weeks. Such a big rally, you had to take your glasses off. You've got some
I know,
got your allergies going on, right?
Yeah, I have allergies. I'm wearing glasses, and I just took it off because it's just the light is just too bright. Well, so you're kind of big. I can see you. I can see myself.
I'm here. I'm wearing my Cincinnati red shirt. If you squint really tightly at the monitors, there's some green out there. There is some green out there. Yeah. What do you think really truly sparked this incredible rally we've seen the last 5 weeks approximately?
Three words: Liberation Day canceled.
There we go. Oh, I like that. We should make T-shirts. Liberation Day canceled.
But basically, that's it. I mean, we've rolled back the tariffs. Even the extreme tariffs on China. The big news last Monday. We're recording this on Wednesday, May 14th. On Monday morning, the big news was that the China tariffs will be rolled back from 145%. People are thinking, okay, if we get down to 50%, that'll be good. We got all the way down to 10%. Right now, again, this is, I think the U.S. side calls it a deal. The Chinese side says this is a mechanism to talk. Basically, you've agreed to talk.
Right.
Breathe a sigh of relief. Right. But I think it's a big deal to go from 145% tariffs, the risk of Christmas being canceled, Thanksgiving being canceled, Halloween being canceled. And now, we get to buy 30 Barbie dolls.
There we go. That's reason to celebrate by itself. So we've got, again, Liberation Day canceled. Also, earnings season's like wrapping up. Yep. And if you look at the first quarter earnings season, S&P 500 up well over 13%, close to almost 14%, I believe now. At at the start of earnings season, expect to be up about 6.5%. So long-winded way of saying earnings came in a lot better. We get it. Guidance is murky. A lot of companies straight up said, we're not going to give guidance. We're not sure what's going on with tariffs. The reality, though, is we dodged the bullet, I think, on the economy just screeching to a halt, which with earnings and the better news on trade are two things clearly that have made this market, which was in a near bear market on April 8th. We talked about that a lot, down 20%, comes soaring back. The S&P, the time we're doing this, is actually up on the year. Who knows when you watch this if we're going to be up on the year, but that's a big comeback. One more from me, Sonu, then I'll go to you. A little technical, but we like to do that sometimes. If you look at the S&P 500, 58% of all the stocks in the S&P 500 earlier this week made a 1-month high. What in the world does that mean? That's called a buying thrust. I looked at history. 20 times we've seen that happen. 1 year later, S&P is higher. Drum roll, please. 20 times. That's just one data piece. We've laid out some other ones in these Take Fives the last couple of weeks. There's some signs that the lows indeed are in. But Sony, the question, do we just go straight up from here? Are we going to be up another 20% when the year is over with no volatility and no scary headlines?
I think we've reset. What's happened is we've gone back to pre-Liberation Day. Yep. The S&P is actually, as we're speaking now, I think the S&P 500 is slightly up for the year, which is amazing to think about, considering where we were a month ago.
Oh, yeah.
Right. But we're still slightly, 4% off the highs on February 19th. Other pockets of the market, whether it's small cap stocks, the Dow, transportation averages, home builders, they're still down a lot more. So there's some hurt out there, which is not to, all this to say the trade war has taken a toll.
Yeah.
Right. And one place where I think the biggest toll has come is that it's caused the Fed to pause. We just got a positive inflation report for April.
Yep.
And it was, inflation, you and I have been talking about this for a long time. Inflation had normalized. I thought we thought it had normalized last year this time. But inflation is not a problem anymore. Normally, what do we be talking about? The Fed cutting rates, cutting interest rates, giving relief to homeowners, manufacturing firms, people who need to borrow, all of it. Now we're not talking about that anymore. In fact, I think after the Fed meeting last week and Fed Chair Powell talking, during the press conference, they've taken a June cut off the table. Yeah. Maybe a July interest rate cut is off the table. We may be looking at September, but if the economy hangs in there, which is very possible, especially after all this, we may not get any cuts at all this year. So expect volatility around that. That's not to say, look, if the Fed cuts a lot very quickly, that's not a good sign. That means the economy is breaking. Right? We don't want that. But at the same time, if you don't get any relief from interest rate cuts, I think we see some volatility.
No, well said there. I mean, 4D chess, you could say, well, if the Fed doesn't cut, maybe it's because the economy is strong and they don't need to cut. And believe me, there's a lot of avenues we can go with this. Reality, we do think the Fed should be cutting a couple of times sometime later this year. But if the economy is hanging in there and strong and we avoid a recession that was being priced in this time about 4 or 5 weeks ago, which is still our base case, honest to goodness, even in the depths of the near bear market and a lot of forecasts for a recession, we upped our potential for a recession, but we never came out and said it'd be a recession. No. And now you've got the pullback on trade, and maybe we can get things moving again. And like you said, Halloween, Christmas, Thanksgiving, none of those fun things end of the year are hopefully going to be canceled now. So with all that, everyone, this is the latest Carson's Take 5 with Ryan and Sonu, why the lows could be in. We'll see you next week. Take care. Thank you.